If you've been watching silver like it's just another commodity trade, I need you to pay closer attention right now. Because while markets are focused on short-term price action and trading narratives, something more fundamental has been developing beneath the surface. Mark here from GoFinance, where we break down market structure and supply chain dynamics that often get overlooked in mainstream analysis. For roughly 2 months, silver has been moving in ways that have caught many participants off guard. The price action itself isn't the full story. What matters more is understanding the underlying mechanics and why different market participants are interpreting this situation so differently. You have one group treating this purely as a momentum trade. They're convinced the primary strategy should be positioning for a reversal, simply because prices have risen significantly. But that approach lacks structural analysis. It's pattern recognition without understanding the fundamentals beneath the pattern. Meanwhile, the participants who actually need physical silver, manufacturers, industrial buyers, supply chain managers, they're not focused on chart patterns. They're focused on deliveries. They're focused on inventory availability. They're focused on whether the metal actually shows up when production schedules require it. And that's where the real tension is building. Let me give you the recent timeline in a way that clarifies the situation. Not long ago, silver was trading around $60 per ounce. Then it moved significantly higher into triple digits, and it's been holding above $100 while experiencing notable volatility. Gold has been moving substantially as well. The entire precious metals complex appears to be in a period of price discovery that's challenging many participants' assumptions about what constitutes normal market behavior. But here's what I need you to understand. If you're only watching price movements, you're missing a critical layer of market structure. Because the real question isn't just what's the price, it's what does the physical delivery system look like? And that's where things get interesting. Today, I want to walk you through 3 areas that provide important context. First, recent changes in margin requirements and exchange mechanics, and why the motivations behind these changes may be different than many assume. Second, global supply chain dynamics that are quietly turning a price story into a physical availability story. Third, how different narratives are influencing participant behavior in ways that create significant risk asymmetries. And I'm going to tie it together with one question you need to consider carefully. Are you analyzing this as a trading opportunity or as a structural shift in how this market functions? Before we continue, if you find this type of structural analysis valuable, let me know in the comments. Your feedback helps me understand what content provides the most value. Let's start with exchange mechanics and margin requirements, because this is where a lot of misunderstanding occurs. If you've followed commodity markets for any length of time, you've seen exchanges adjust margin requirements during periods of high volatility. Many participants have a standard interpretation. The exchange raises margins to cool off the rally, protect large participants, and make it harder for smaller traders to maintain positions. That's often the narrative, but let's look at what might actually be happening from a risk management perspective. What we're observing could be less about deliberately suppressing price and more about the exchange managing its own operational risk. A futures exchange isn't just a trading venue, it's a clearing mechanism. And that mechanism only functions properly if adequate collateral is posted, and if deliveries can be handled without creating systemic stress. Based on publicly available inventory data, holdings at approved warehouses have been declining. Deliverable stock, meaning the physical metal actually registered for delivery against futures contracts, has been one of the metrics that market observers keep monitoring closely. Now, I'm not here to overwhelm you with warehouse spreadsheets. I'm here to explain why this matters structurally. Futures contracts represent obligations. Many of those obligations never convert to physical metal. They get rolled forward, closed out, or cash settled. That's normal market function. But when a higher percentage of long positions start behaving as though they actually want physical delivery, the dynamics change. The question becomes, how many paper obligations are stacked on top of each ounce that can actually be delivered? And when that ratio starts looking uncomfortable, the exchange faces a challenge. This is where margin mechanics become significant. Instead of margin being a fixed number you can budget once, exchanges can shift to structures that scale with notional value. That might sound technical, but here's what it means practically. If you're short and price rises, you're losing money. Everyone understands that. But if margin requirements also scale with the contract's notional value, then as price rises, you also have to post additional collateral while you're already experiencing losses. That's a compounding pressure. It doesn't just create discomfort, it forces decisions. And this is why simply saying raise margins to 100% doesn't capture the full mechanism. The exchange doesn't necessarily need dramatic one-time moves if it can create a system that automatically tightens as conditions intensify. So consider what happens to a short position that was established at lower prices, potentially with leverage, possibly across multiple accounts when price continues climbing and collateral requirements keep scaling. At some point, the short either needs to add capital or close the position, and closing means buying, and buying creates upward pressure. Here's something to hold in your mind. If margin structures are now designed to automatically increase pressure on leveraged short positions as price rises, then every significant price spike isn't just a price movement, it's a stress test of the system. And stress tests eventually reveal weak points. This brings us to an important question about who the exchange is actually protecting. Decades ago, many exchanges operated essentially as member-owned clubs. Today, these venues often function as publicly operated businesses with shareholders, regulatory obligations, and reputational considerations. When markets become disorderly, exchanges aren't just concerned about one institution or one trader. They're concerned about the integrity of the entire clearing process. Here's some uncomfortable arithmetic that often gets overlooked. Total warehouse inventory is not the same as deliverable inventory. A significant amount of metal can sit in warehouses as eligible inventory, meaning it meets specifications, but that doesn't mean it's necessarily posted for delivery against contracts. Registered inventory is what can actually be used to settle futures obligations. When registered inventory declines, the paper market is effectively operating with a smaller physical backstop. According to recently published data, total holdings in approved warehouses have decreased meaningfully from recent highs, reaching levels not seen since earlier in the year, even as prices have surged significantly. Feel the tension here. If paper claims are substantial and the deliverable pile is shrinking, the exchange faces two challenging options. Either allow leverage to continue unchecked and risk a cascade failure, or tighten collateral requirements and force out weaker positions before the problem escalates. So when people say they raise margins to kill the rally, consider an alternative interpretation. They raise margins to maintain system integrity. And here's your next consideration. If the exchange is concerned about system integrity, what do you think industrial buyers are worried about? Because industrial buyers don't benefit from margin adjustments. They don't consider cash settlement a satisfactory outcome. They need actual metal, and they need it according to production schedules. That's why one of the most revealing signals isn't just price movements, it's behavior around delivery periods. When delivery activity looks heavier than normal in months that historically haven't been primary delivery months, that's not speculation, that's urgency, and urgency tends to be contagious. Now you might be thinking, okay, that's futures market plumbing, but isn't this primarily speculative activity? Let me address that directly, because this is where a lot of analysis goes wrong. The demand patterns we're observing don't look like typical speculative behavior. They look more like participants trying to secure physical inventory in an environment where availability isn't guaranteed. And that brings us to supply chain dynamics. Let me connect this to something that often gets overlooked: the intersection of industrial transition and materials demand. Based on recently published data about global solar capacity additions, the world added over 600 gigawatts of new solar installation last year. Total installed solar capacity exceeded 2 terawatts globally. That's not a theoretical talking point. That's a massive amount of physical hardware. And silver plays a critical role in that hardware, particularly in conductive pastes and electrical contacts within solar panels. Even as manufacturers work to reduce the amount of silver per panel, the sheer volume of panels being produced means total silver demand from this sector can still increase substantially. And solar is just one application. Any technology that requires high conductivity, reliability, and corrosion resistance tends to incorporate silver in some capacity. This is why silver keeps appearing in discussions about strategic supply chains. Now here's where the China dimension becomes important and often misunderstood. When people hear China and silver, many immediately think about mining. But a significant portion of global refining and processing capacity is concentrated in Asia. Supply chains that took decades to build don't relocate in a single quarter. When export controls, licensing requirements, or prioritization mechanisms get introduced, whether for silver specifically or for adjacent critical materials, the entire global flow becomes slower and more constrained. And this is why the idea that a single headline won't matter can be dangerous. The physical market doesn't necessarily need an absolute ban to experience stress. It only needs delays, additional paperwork, and prioritization systems. Because in just-in-time manufacturing systems, delays effectively function as shortages. So if you're wondering why price spreads between regions can widen, why premiums can persist, why certain product forms seem to become scarce, it's because supply chain friction is being priced into the market. And here's what should make you pay attention. When a commodity becomes strategically framed by governments, the market stops being purely economic. It becomes political. And political markets don't tend to resolve smoothly. Many people focus primarily on mining, who extracts the ore from the ground. That's the first step. But the metal that gets mined isn't the metal that a semiconductor manufacturer uses. It has to be processed, refined, transported, and fabricated. That chain isn't infinitely flexible. And here's something that should give you pause. Most silver isn't mined because someone decided to mine silver specifically. It's mined as a byproduct of extracting other metals. Copper, lead, zinc. Silver comes along for the ride. That means if the silver market signals a need for more supply, the industry can't simply respond by deciding to mine more silver. Even if prices double, the byproduct nature of most silver production makes supply response slow. Mines don't reconfigure overnight. Permitting doesn't happen overnight. Refining capacity doesn't expand overnight. And when the bottleneck is refining capacity rather than just raw ore, leverage shifts toward whoever controls the refining process and export infrastructure. Based on publicly available policy documents, silver has been included in strategic materials discussions in the United States, appearing on updated federal critical minerals lists. That matters not because a list magically changes reality, but because it indicates how governments are beginning to frame supply chain considerations. When a material is treated as strategic, the priority becomes security of supply rather than efficient price discovery. Now add the international policy dimension. There have been escalating actions around key materials, and supply chain concentration risk is a prominent theme in policy discussions. You don't need to take my word for this. Just observe what's happening in renewables and electrification. Solar capacity has been expanding at a pace that continues surprising even optimistic forecasters. And that expansion creates real manufacturing demand for silver. Not speculative demand, but actual consumption and production. Here's an uncomfortable reality. When demand is structural and supply is constrained, price doesn't necessarily mean revert simply because it feels elevated. Price continues rising until something changes fundamentally. So what changes first? This is where substitution comes up. Some will argue that manufacturers will simply replace silver. And yes, engineers can substitute materials if budget is unlimited and performance degradation is acceptable. But in reality, designs are built around specific material properties. Substitution requires time, retooling, qualification testing, reliability validation, and sometimes complete redesign. And for certain applications, you cannot substitute without losing efficiency, durability, or safety margins. This is why I'm skeptical when someone dismisses the entire move as purely speculative mania. If it were only speculation, supply chains wouldn't be under strain. Deliverable inventories wouldn't be a daily focus. Industrial buyers wouldn't be securing supply at elevated prices. The conversation would be about sentiment rather than physical settlement. Let me challenge one prevailing narrative directly. Many participants are treating retail demand as the primary driver of this move. I'm not denying retail participation matters, but I'm saying it's being overstated as a convenient explanation. When institutions and commentators want a simple story, they favor retail mania narratives. It allows them to dismiss the move, characterize participants negatively, and avoid addressing underlying fundamentals. But observe the actual market footprints. When you see enormous volume trade and then open interest barely changes, that's not a crowd building massive new directional positions. That's churn. That's hedging. That's options-driven flow. That's market makers performing their function. Which brings us to the third area, how narratives influence behavior. This is the part that concerns me most because it's not just creating confusion, it's creating risk asymmetries. Here's a perfect example of how narrative machinery works. You'll see a story circulate about some index rebalancing or forced liquidation event with a specific date. Suddenly, everyone becomes convinced that date represents inevitable downside. Participants start positioning for that outcome. They reduce exposure. Some establish short positions. Then the date arrives and the apocalyptic scenario doesn't materialize. The market moves on, and the people who positioned for disaster are left managing unnecessary losses. That's not random. That's how positioning gets manipulated through narrative rather than through actual market mechanics. In commodity markets, the difference between a reference index and an actual forced seller is everything. Most participants don't understand that distinction, so they react to headlines rather than analyzing actual flows. And here's what makes it worse. Once someone gets caught in this pattern once, they often conclude the market is rigged against them rather than recognizing they responded to a simplified story without proper verification. So when you hear everyone has to sell, ask the critical question, who exactly is forced and where is that forced flow actually coming from? If you can't answer that specifically, you're trading narrative rather than structure. There's a significant online presence right now encouraging people to short silver because it's obviously going to crash. They present this with confidence, sometimes with condescension. And most don't properly define the risk. They don't explain what happens if the analysis is wrong. They don't explain how margin works when volatility spikes. They don't explain that exchanges can demand additional collateral while you're already experiencing losses. They don't explain that shorting into a physical squeeze can result in losses driven by market structure rather than just price patterns. And here's the concerning part. Many promoting this approach have been conditioned by other markets to believe every vertical move must reverse immediately. They think everything behaves like highly liquid, electronically traded instruments. But physical commodities don't respond to sentiment the same way. Physical commodities respond to actual supply and demand for the physical product. And when you combine physical drawdowns with a leveraged paper market, you create conditions where volatility isn't the end of the story. Volatility is the mechanism forcing position changes. Let me make this practical. If you're considering establishing a short position, I want you to answer two questions honestly. First, if price moves against you, how much can you afford to lose before you're forced to close? Second, if you're forced to close, who do you think is on the other side ready to buy from you? Because here's the typical pattern. Crowds get positioned short. Price spikes, stops trigger, shorts cover by buying. That buying creates more upward pressure. Then the same crowd says, see, blow off top, and shorts again. The cycle repeats until account balances can't sustain it. That's not strategic trading. That's providing liquidity to others. Now, some of you are thinking, if this is all so clear, why aren't major media outlets explaining it? Sometimes it's because the analysis is genuinely complex. People covering these markets daily may not live in the detailed mechanics. But sometimes it's incentive structures. Complex explanations don't drive engagement. Simple narratives spread more effectively. Retail mania spreads easily. Short it because it's high spreads easily. The exchange will crush it, spreads easily. And in that noise, the average participant can miss the actual structural opportunity, not a quick trade, but positioning for an environment where monetary conditions continue creating pressure on hard assets. Now let's address international price differentials, because this is where theory meets reality. In a genuine shortage, price doesn't remain uniform globally. Price fractures. The quoted price on your screen becomes less relevant than the actual bid for physical metal in specific locations. When one market trades at a persistent premium to another, that's not trivia, that's information. It signals that physical flow is constrained. And here's what makes this revealing. When a premium persists, even as headline price rises, it suggests the gap is about access rather than speculation. That's when you start seeing unexpected behaviors, like metal leaving certain vehicles during a rally. Not because investors are bearish, but because the physical metal is more valuable in the supply chain than sitting behind a ticker symbol. Think about it this way. A share represents a claim on a structure. A physical bar is a physical bar. In a tight market, the bar has different utility. So when someone says, don't worry, there's plenty of silver, look at the total market cap. Just recognize that market capitalization doesn't deliver material to a factory. Market capitalization doesn't solder circuits. Market capitalization doesn't keep production lines operating. Only physical metal does that. Here's a question for the comments. Would you rather own a financial claim or own something that manufacturers cannot operate without? Now, I'm not going to give you a precise price target with a specific date. Anyone providing that level of certainty in this environment is selling confidence rather than analysis. What I can provide is framework and context. The broader discussion in silver markets has centered on recurring supply deficits, years where demand exceeds production, meaning inventories do the balancing. Whether those deficits are large or modest in any given year, the direction matters. Because once inventories reach sufficiently low levels, markets become fragile. Fragile markets don't need massive catalysts to move significantly. They only need small surprises. A delayed shipment, refinery maintenance, a policy shift, a major buyer deciding to build inventory rather than operate lean. Suddenly, what seemed impossible becomes a normal week. This is why I keep emphasizing inventories and physical availability rather than just price. Price is the signal, but inventory is the underlying reality. In physical commodity markets, price has one job: ration demand and incentivize supply. When there's insufficient metal, price rises until someone backs away. It rises until a buyer says, not at this level, or until a producer says, now it's worth expanding capacity. But because supply response is slow and demand is tied to critical manufacturing, that rationing function can be volatile. It can overshoot, it can spike, it can correct sharply. And all of that can occur within a longer-term structural move. So if you're watching a pullback and thinking, that's the top, be cautious. In tight physical markets, pullbacks often represent the market taking a breath, while stress shifts from one part of the system to another. Here's a question I want you to consider and answer in the comments. Do you think the bigger risk right now is price declining or physical metal becoming genuinely unavailable? Because those are fundamentally different problems. A price decline is a mark-to-market issue. Unavailability is an operational crisis. Companies can manage mark-to-market fluctuations. They cannot manage production lines stopping because input materials aren't available. And that's why industrial demand can become relatively price insensitive at the margin. If a factory produces high-margin products and silver represents a small fraction of unit cost, they'll pay elevated prices to maintain operations. That's how shortages self-reinforce. Let's address the derivatives dimension, because this is where volume can be misleading. In modern markets, derivative activity can drive the underlying asset in the short term because dealers hedge their exposures. That's not conspiracy, that's market mechanics. When large volumes of short-dated options get traded, the hedging flows can create sudden price movements in both directions. Then when those options expire, that flow disappears. So you get days where everyone focuses on enormous volume. And then the next day, open interest barely moved and people are confused. That's why you need to distinguish between noise volume and actual position volume. If you don't make that distinction, you'll misread the situation and potentially position on the wrong side. Here's something most people don't anticipate. If markets are being influenced by short-dated options around specific strike levels, the most significant moves can occur right after expiration windows close, because the artificial pressure disappears and price can snap back to where physical demand actually wants it. So if you're waiting for the safe entry after a dramatic dip created by options hedging, you might be waiting for something the market has no incentive to provide. Let's zoom out and discuss what could actually resolve this situation, because that's ultimately what you want to understand. How does this end? There are only a few ways genuine physical tightness eases. 1. Demand destruction. Not a temporary pullback. Actual factories slowing, projects getting delayed, entire sectors cooling. That can happen, but it's neither instant nor painless. 2. Substitution. As we discussed, it's slow and limited. 3. Supply response. Higher prices eventually pull new mining, refining, and recycling capacity online. But that's also slow. 4. Policy intervention. Export controls, strategic stockpiles, prioritization systems, all the complicated measures governments employ to secure materials. None of those are clean, quick, or guaranteed to return prices to previous levels. Let me be crystal clear. I'm not saying markets can't correct. They absolutely can. In fact, they probably will multiple times because volatility is how systems shake out weak positions. What I am saying is that correction doesn't necessarily mean the underlying thesis is invalid. And the most dangerous assumption you can make is it went up, therefore it must crash, without understanding what's underneath. Because when the underlying dynamic is physical tightness, the worst days for short positions aren't calm days. The worst days are when price gaps, exchanges tighten requirements, borrowing costs shift, and suddenly a manageable position becomes a financial emergency. I want to address a psychological pattern I keep observing. People saying it happened before and pointing to historical spikes and corrections as though they're laws of physics. But markets don't repeat just because you expect them to. They repeat when conditions match. So ask yourself, do conditions match? Is the supply setup the same? Is industrial demand structure the same? Is the derivatives ecosystem the same? Is the policy environment the same? Is system leverage the same? If you can't answer those specifically, you don't have analysis, you have pattern recognition based on nostalgia. And nostalgia isn't a risk management tool. Here's an uncomfortable reality about institutional behavior. Many institutions don't short because they have deep independent analysis. They short because the trade is suggested to them through their network. Prime brokers, research notes, desk conversations. It's social proof with a Bloomberg terminal. And if the dominant narrative in the room is retail excess, they feel safe shorting. But that's exactly how you get crowded positioning in the wrong place at the wrong time. And when the crowd is wrong in leveraged markets, the correction isn't gentle, it's severe. Before we move to the final section, let me repeat something important. If you're finding success with your approach, share that in the comments. Others benefit from seeing what's actually working. The context matters when fear gets loud. Final area, a question many have, is price manipulation occurring? Look, markets are always subject to various influences. Anyone who thinks price is some pure expression of fundamental value hasn't watched how options expiration affects behavior. But here's what matters. The tighter the physical market becomes, the less sustainable paper-based pressure becomes. You can influence price temporarily. You can trigger stops. You can create short-term fear. You can run technical levels. But if physical buyers continue pulling metal, eventually that pressure becomes unsustainable. That's why you'll see battle lines form around certain price levels. Sudden moves down, then rebounds, then pressure again, then recovery. It looks like chaos, but it's actually tension between paper-based pressure and physical-based demand. And once key options windows close, once that temporary pressure dissipates, price can move sharply. So if you're thinking, I'll just short the next spike, understand? The next spike might be the one that doesn't reverse. Now let's shift focus from the market to you specifically. What are you actually trying to accomplish with silver exposure? Are you trying to generate quick profits? Or are you trying to build positioning that provides protection in an environment where currencies get diluted, costs rise, and hard inputs become strategic considerations? Because those are different objectives and they produce different behaviors. If you're focused on quick profits, you'll probably overtrade. You'll probably chase. You'll probably short things that frighten you. You'll probably experience significant volatility in account value. If you're focused on strategic positioning, you'll think in terms of appropriate allocation, maintaining liquidity, and suitable time horizons. You'll respect volatility rather than trying to exploit every swing. For those who want deeper analysis that we don't publish publicly, we do produce members-only content that's created with additional research depth and detail, available only to premium members. If you want that additional layer, the link is in the description. Let me close with final thoughts and 2 questions I want you to answer below. First, do you think the primary narrative gap right now is the assumption this is purely retail driven? Second, if physical tightness persists, what do you think experiences pressure first? Manufacturing margins or end consumer demand? Answer those in comments. I read them and they inform future content direction. And remember to check the description for additional resources, including membership information. One more thing, because I care about you managing risk appropriately. If you're considering short positioning, be honest about your motivation. Is it based on researched structural analysis, or is it emotional response to feeling late? Emotional positioning is how accounts get damaged. If you want to participate, do it with a plan. Do it with position sizing that doesn't break you if you're wrong. And do it with humility about what you can and cannot control. Because in tight physical markets, the system doesn't care about your ego. It only cares about who needs the actual material and who can remain solvent longest. If you want me to analyze the next delivery report when it's released, let me know below and I'll consider it for upcoming content. If this structural analysis helped clarify the situation, hit like so it reaches others who might benefit. Subscribe if you haven't, and drop GoFinance in comments to support the channel. As always, this is educational analysis and perspective, not personal financial advice. I'm sharing how I analyze market structure so you can conduct your own research, assess your own risk tolerance, and make decisions appropriate for your specific situation. This is Mark from GoFinance. Thanks for watching.